Welcome back. We have a packed agenda today, but before we get started, I have a quick but very important announcement for our professional listeners. If you're tracking your professional development, please do note that by listening to this discussion and completing the quiz that goes with it, you will earn a CPD certificate.
That's right. So it's definitely worth paying close attention.
It is, because we are covering a really significant shift in the financial landscape today, and you want to catch all the details.
It's a shift that I think fundamentally changes the playing field for everyone. Advisors, bankers, consumers, you name it.
And to really get a handle on that playing field, you have to look at the research. The central idea here is, well, it's fascinating because it completely goes against the story we were all told a decade ago.
You're talking about the David versus Goliath story.
Exactly that. Think back to, say, 2010, 2011. The iPhone's taking off, apps are everywhere, and the story in the business world was pretty aggressive.
Oh, yeah?
It was. The banks are dinosaurs. They're too big, too slow, too expensive, and these little fintech startups were going to come in and just burn it all down.
That was the unbundling of the bank idea. The theory was that these startups would just pick off all the profitable bits one by one, payments, lending, Forex.
And do them better and cheaper?
Precisely. And leave the big banks with just the boring low-margin stuff. It was meant to be an extinction event.
But looking at the analysis today, especially for the South African landscape, that war, it never really happened, did it?
No. Or at least the ending was totally different from what everyone predicted. It wasn't a war, it was more like an integration.
An integration?
Yeah, the research argues that fintech didn't replace the banks, it sort of permeated them. We've moved from an era of disruption to what we're now calling embedded infrastructure.
So fintech isn't the shiny app anymore, it's the plumbing.
It's the plumbing of the entire financial system. You don't see it, but nothing works without it.
Which is a much deeper revolution, even if it's quieter. Okay, so the plan for today is to trace that journey. We'll start with the Wild West days, move through the institutional reality checks, and get to where we are now, where the tech is basically invisible but completely essential.
And crucially, we'll look at what this all means for you, the financial professional. Because if tech is now infrastructure, that really changes how you think about risk.
All right, let's start at the beginning. Phase 1, the disruption era. We're talking roughly 2008 to 2018.
To get this era, you have to remember the global mood. 2008 was the global financial crisis. Now, South African banks were pretty conservative. They didn't really get caught up in the whole subprime mess.
They were stable.
Very stable. But globally, the reputation of banking was in the gutter.
Trust was at an absolute all-time low. People were looking for literally anyone else to handle their money.
Exactly. People were furious with the system. And at the exact same time, you had this explosion in mobile phone use. So you had a trust problem and a new delivery channel, the smartphone colliding.
And the promise was that fintech would, democratize finance.
That was the word. It would cut the fees, remove the friction, and finally serve the underbanked.
You can't really talk about this time without bringing up M-Pesa in Kenya. It feels like that was the real spark for the continent.
Oh, M-Pesa is the textbook case. It proved you didn't need a bank branch. You just needed a SIM card. It turned a phone company into a bank.
And entrepreneurs here saw that and thought.
They realized the barrier to entry wasn't building a giant vault anymore. It was just writing good code.
This is where we see players like Yoko coming in. I feel like Yoko is such a perfect example of that phase 1 energy. I just remember suddenly seeing those little white card machines popping up everywhere.
It is, because they found a gap. The big banks were just ignoring the tiny merchant, the guy selling coffee at a weekend market.
Right. Before them, getting a card machine was a nightmare.
It was impossible. You needed a huge turnover, you paid high rental fees, the banks just couldn't justify the paperwork for a small vendor.
So Yoko used mobile tech to solve that.
They completely changed the risk model. They said, look, just buy the device once, hook it up to your phone, and we'll take a tiny slice of each sale. It brought the informal economy into the formal one.
And that's key. It wasn't just about convenience.
No, it was about data. Suddenly, that coffee seller has a digital transaction history.
Which means they can prove their income.
And once you can prove your income, you're visible to the credit system, you can get a loan. That's the real power of that early phase, turning invisible cash into visible, useful data.
That's the real inclusion. Then, towards the end of this phase, Time Bank launches. And that felt like a huge step up, not just a gadget, but a whole bank.
Time Bank was a massive milestone, the first fully digital, branchless bank to really get to scale here. They solved the customer acquisition cost problem.
The CCAC. Why is that so important?
Because it's incredibly expensive for a traditional bank to get a new customer. You've got the branch, the staff, the paperwork. Time Bank threw all that out. They put a kiosk in a grocery store.
I remember doing it. You scan your ID, and a card pops out in minutes.
Yeah.
It felt like science fiction.
And their cost to get you as a customer was a tiny fraction of the big banks. So by 2018, the feeling was very much, the branches are dead, the old banks are finished.
They weren't. The big five are all still here, and they're more profitable than ever. Which brings us to phase 2, the reality check. So why didn't the disruptors win?
Because, well, banking is really, really hard. The startups all hit what's called the scale wall.
The scale wall.
It's easy to build a slick app. It's incredibly difficult to manage liquidity risk, handle a massive balance sheet, and navigate compliance.
The red tape.
And it's essential red tape. The fintechs realized that to offer real banking products, like a mortgage, they needed the licenses and the capital that the banks already had, the whole move fast and break things idea from Silicon Valley.
Doesn't work when you're handling people's life savings.
Exactly. You can't break that.
And the regulator, the South African Reserve Bank, they weren't just watching from the sidelines during all this, were they?
No, and this is where South Africa's story is quite different. In many countries, regulators either banned the new tech because they were afraid of it, or they just ignored it. The SAR was proactive. They created the regulatory sandbox.
Right. It sounds like a playground, but I'm guessing it's a bit more serious.
It's basically a controlled test environment. A startup could test a new product with real customers and real money, but within very strict limits.
So if it went wrong, the damage was contained.
Exactly. It allowed for innovation without putting the whole system at risk. And this was happening right as we shifted to the Twin Peaks regulatory model.
We hear Twin Peaks all the time. Can you give us the short version?
Of course. It just splits regulation into 2 parts. Peak 1 is the Prudential Authority. They make sure the bank is stable, that it has enough cash. Peak 2 is the FSCA, the Financial Sector Conduct Authority. They focus on behavior. Are you treating customers fairly?
And the fintechs had to comply with both.
Yes. And that forced them to grow up fast. You couldn't just launch and see what happened. You had to build compliance into the code from day 1. And that really is what pushed them to partner with the banks who already had these huge compliance teams.
So the story changes from fighting to partnering.
Right. We saw the rise of API banking. An API is just a software bridge that lets a fintech plug directly into a bank's systems. The bank provides the license and the balance sheet, and the fintech provides the slick user experience.
Which brings us to today, phase 3, embedded infrastructure, the invisible phase.
It's invisible because it's working so well. It's like electricity. You don't think about the wiring in your walls, you just flip a switch. You only notice it when it breaks. Fintech is now the electricity of money.
And the prime example of this seems to be PayShap.
PayShap is the perfect example. It's not one bank's app. It's an industry-wide payment rail that allows for instant, low-cost payments between anyone at any bank.
But we've had instant payments for a while, right? What's new here?
2 things: cost and identity. It's designed to be much cheaper to actually replace cash. But the big technical leap is something called proxy resolution.
Proxy resolution. Okay, what's that?
In the old system, to pay you, I need your bank, your branch code, your account number. It's a hassle. With PayShap, I just need your phone number. The system links or resolves that number to your bank account behind the scenes.
So I just pay your number and the money arrives.
Instantly. That is pure fintech infrastructure, but to you, the user, it just feels like your normal banking app got better. The fintech layer has disappeared into the banking layer.
And this is happening in the back office too, right, with AI?
Oh, absolutely. AI is doing the real heavy lifting now, especially in 2 places: credit scoring and compliance.
Okay, so with credit scoring, how does that work?
Well, traditionally, if you didn't have a formal payslip, you were invisible to the credit system. AI allows for what we call alternative data scoring. The algorithms look at your behavior, how you pay your bills, how often you top up airtime to build a risk profile.
So it makes the informal economy visible to lenders.
It does. And on the compliance side, it's the only way to keep up. Humans can't possibly monitor millions of transactions a day for money laundering. AI does it in real time, 247, and flags the weird stuff for a human to look at.
Even the government is getting in on it, with the Reserve Bank looking at central bank digital currencies.
That's the ultimate sign, isn't it? When the central bank itself is running on the same kind of tech the startups were pioneering a decade ago, the disruption is over. The rebels are now the establishment.
But there's always a but. When everything is this connected, doesn't that create a new kind of risk?
It creates a massive one. We call it operational concentration risk.
The one-switch problem.
Think about it. You might have 5 different banks and 10 different apps. Looks diverse, right?
Yeah.
But what if they all run on the same cloud provider, like Amazon Web Services?
If Amazon has a problem.
The entire financial system goes dark, all at once. It's a single point of failure. We've disguised this systemic risk as efficiency.
And we've seen small versions of this when an outage takes down several banking apps for a few hours.
Imagine if that lasted for a day or a week. The economy would just freeze. The risk isn't just about money in a vault anymore, it's operational. It's about your server's backup power.
That's a chilling thought.
Yeah.
And there's another risk, which is less about a crash and more about who gets left out. The digital divide.
We have to be honest about this. Yes, a mobile wallet is great, but it depends on you having a smartphone, data, electricity, and a cell signal.
And if you live in a rural area with patchy coverage,
PayShap is useless to you. If we get rid of cash too quickly, we risk creating a 2-tier economy. A super fast digital one for people in cities, and a slow, excluded one for everyone else.
Okay, let's bring this back to the listener. For the financial planners, the advisors listening to this, what's the big takeaway?
I think the biggest shift is this idea of technology as fiduciary.
Break that down for us.
Your fiduciary duty used to be about picking the right fund. Now you're also a technology curator. If you use a platform for your client's data or a robo-tool for their portfolio, you are responsible for how secure and resilient that tech is.
You can't just pass the buck to the software company.
Not anymore. If the platform is breached and your client's data is stolen, that's on you. Due diligence isn't just about fees anymore, it's about cybersecurity protocols.
And what about that old fear that robo-advisors would replace humans? Is that still on the table?
That debate is pretty much over. The data shows the pure robo model doesn't work well when markets get scary. People don't want an algorithm when they're panicking.
They want a person. They want empathy.
Exactly. The winning model is hybrid. Use the tech for the numbers, the rebalancing, the tax stuff, but use the human for the coaching, the context, the behavioral side of things.
The cyborg advisor?
Sort of, yes, but the expectations are much higher now. It's the Amazon effect. Your clients expect real-time dashboards and instant updates. A PDF report once a quarter just looks ancient.
So technology hasn't replaced the advisor, but it's forced the advisor to evolve.
Evolve or become irrelevant, yes.
So, to sum up the journey, we started in the Wild West, the era of unbundling, where everyone thought fintech would destroy the banks.
Then we hit the reality check where compliance and cost forced them to partner up instead.
And now we're in the embedded infrastructure phase. Fintech is the plumbing. It's invisible, but it's everywhere.
But that comes with huge new risks like concentration and huge new responsibilities for professionals.
It really does change how you see your banking app. It's not just an app, it's the tip of a very, very large iceberg.
That's a great way to put it.
Before we sign off, I just want to leave you with one final thought. We've talked about how fintech was adopted by the system. But if fintech is now the backbone of the entire financial system, have we moved past adoption?
It's the big question, isn't it? If the system is the technology, then the game has completely changed. The question is no longer, will fintech replace banks?
The question is?
The question is, how do we manage the risk of our entire economy sitting on a single digital foundation that we can't even see?
Something to think about. Thanks for joining us. And don't forget to complete that quiz to earn your CPD certificate.
Stay curious.
See you next time.